In this 9th video of the Muslim Investing 101 series, we'll explore case studies of debt versus investing. Let's follow $100 in debt and $100 invested over a long period of time. And in order to do this, we'll bring back our friends Akram and Tariq. Akram spends $100 on his credit card and forgets about it, whereas Tariq invests $100 and forgets about it. What happens over the long term? We know that credit card debt is very, very pernicious. It grows very fast because interest rates on credit cards are quite high. And we know that while investing grows slowly in the market, it does increase significantly the longer it is invested. Let's remember that both Akram and Tariq begin with the same $100 in the bank. For Akram, that money is being spent on a credit card. He intends to pay it back, but forgets about it over the long term. And for Tariq, he actually moves the $100 into an investment account invested in the market. Over the long term, we know that this is going to grow for Tariq and that debt is going to grow for Akram. But how much will both of them grow and what will the difference be? Over the long term, it ends up being about $200 in the investment for Tariq and $587 for Akram. That is a $787 difference, or what we would call in this instance opportunity cost between the two. And of course, what we're not factoring in here as well is the spiritual and emotional cost for Akram taking on $100 of debt and then also paying the interest and accruing the interest over years and years. $787 is a significant opportunity cost, but of course the costs are more than just dollars. Here, the debt versus investment contrast is quite stark. And of course, the difference between spending $100 on a credit card and investing $100 is very obvious. But what if we took on a slightly more subtle question like cars? And let's say Akram today has $10,000 and Tariq today has $10,000. So they both are in the same situation and they both have the same amount of money. Using a car is interesting because it uses a financing mechanism. Putting aside for a second the Sharia compliance of these financing mechanisms to purchase or to use a vehicle. So the math here will look a little different than the simple math that we use with the credit card example, but it nevertheless illustrates the opportunity cost between debt and investing. As has been the case with these two friends, they are in very similar situations, but they take two different approaches, and it has a big impact on their financial lives. So Akram takes that $10,000 that he has and he puts it down for a new Honda Civic lease that is going to cost $263 a month. Now, I know that we're talking about debt versus investing here, and someone might say leasing a car isn't debt. That might be true, and it's true also that there are far more Sharia compliant ways to lease a car than there are to buy a car on a financing deal. But leasing a car has the same impact on your month-to-month expenses, your month-to-month spending, as does paying down a debt. And so for now, we're going to treat them as one and the same, although in reality, the way that they are structured is quite different and can be the difference between a compliant and non-compliant financial agreement. But the impact, nevertheless, on a month's spending is the same. So Akram, $10,000 down, new Civic for $263 a month. And as is the case with leases, 5 years later, Akram needs to pay about $12,500 to buy out the car. And so 5 years later, Akram would need to spend $12,500 to get back to zero or return the car. Now let's think about Tariq. Tariq and Akram were in the same situation. They both had $10,000, but Tariq uses that $10,000 and buys a decent used Honda Civic on Marketplace. And instead of using $263 on a car lease, he instead chooses to invest it. 5 years later, Tariq's investment is $19,313. That's around $3,500 in profit. And now his car, of course, has depreciated in value. And so he has a car now that he could sell for about $5,000. And so this is what Tariq's chart looks like. He went from zero because that's what he had when he purchased the car. His investment grew to nearly $20,000. And that's what it would look like if he sold his car. So now let's compare these two. 5 years later, Akram started with $10,000. He had 5 years with a new car. He paid $263 in his lease And now 5 years later, if he hands back that car in because he doesn't have $12,000 hanging around somewhere, he is now at zero and will need a new car. Whereas with Tariq, he started with $10,000, used that $10,000 to buy a used car, invested that $263, and now because, let's say he sold his car, also needs a new car. Now let's graph this out. This is what Akram's graph would look like. This is what Tariq's graph would look like. The difference between the two is the opportunity cost. It's $24,000. That is the opportunity cost to Akram for driving that new car. Now, of course, there was a difference in experience. Akram's day-to-day experience in that new car was different than Tariq's. But was it a $24,000 difference? Was it worth it? That's the key question. Opportunity cost will never be presented to you like this unless you actually do the math yourself. Think through what this is costing per month and think through what the opportunity cost is over the long term if the money were invested. It's common to hear people say things like, well, leasing a car has tax advantages, especially if you have a business. And that might be true. But now you can actually quantify the cost of leasing a car versus driving a used car. There's a number there to compare it to. And you have a real anchor to make a sound decision. Now let's move this example a little bit further. We're in a situation where 5 years later, both of them need a new car because in Akram's case, he handed the car back in. In Tariq's case, he sold his car. So now they both need cars. Akram is in a situation where he doesn't have any money, and so he's going to lease a new car. He's not going to put anything down. And because he puts nothing down, he's actually going to need to spend $464 a month on this new lease. And for Tariq, he is going to use $15,000 from the money that he's accumulated in his investment to buy another used car that's slightly better than the last one that he drove. And he's going to match Akram. He's going to take $464 now and invest that. Let's see what happens on their journeys graphically. That's what happens at the end of another 5-year run. Akram leasing a car, Tariq buying another used car. 10 years later, Akram is in a situation where he's driven a new car. He has to hand back his leased car, and there's a residual $12,000 or so left on it, and so that's what he would need to pay if he wanted to keep it. He doesn't have that $12,000. He has $0 for a car, and so he's going to have to hand that back in. He's going to be back to zero. And Tariq has been driving a used car, and the used car that he has now is now worth $9,000, and his investment is $47,000. The difference between the two, after Tariq sells his car and after Akram brings his car back into the dealership, is $56,698. So almost $57,000 difference over 10 years. And that's been the cost to Akram for driving a new car, leasing a new car every 5 years. It's important to have that number. What is the opportunity cost to having that new car lifestyle? We're talking about $57,000 over 10 years. And if Akram chooses that that's in fact worth it, that's one thing. But it's important to have a real anchor to make a sound decision. Here are a few takeaways from our Debt Drowns mental shortcut. The opportunity cost between using cash flow for liabilities versus assets grows exponentially over time. So the gap between debt and investing will grow exponentially over time. Experientially, getting into debt is like sliding downhill. So you don't want to start, because once you start, it gets steeper and steeper. Starting to invest is like struggling uphill. It takes a little bit of work to get things started with investing. And so what's important is to set it up now. And then finally, remember that if you're in debt, the best investment after setting up your investments is to get out of debt as fast as possible. So set up the investments, automate $1, and then get out of debt as fast as possible. This video is part of the Muslim Investing 101 series. Be sure to check out the entire playlist. And if you find the videos on this channel beneficial, please like, subscribe, and share.